Thank you very much. So let's consider the topics we'll be looking at this morning together. We'll consider some changes to audit exemption that have been announced, some Companies House changes that have already been implemented, so catching up on those. Again, some accounting changes driven by the changes to the accounting standard. We'll look at particularly two issues that emerged from that. And then briefly touching on Financial Reporting Council, what they see as the current hot topics in accounting, and ESG reporting as well. So let's consider that first topic then of audit exemption. We've had audit exemption for some years, and just as a reminder, it's small companies that qualify to be exempt from the requirement for an audit. And to be a small company, the size criteria has to be met. And if you recall, there are three measures of this: turnover, total assets, and the number of employees. So currently, the requirements are that turnover has to be less than £10.2 million. And we see here how the new limits have increased quite significantly. They've increased by 50%. Now, the last time these changed was back in 2016. So it's been some years since these numbers have changed. And obviously, over that period of time, we've seen the impact of inflation, but also perhaps the current government's desire to reduce red tape. So the new limits that have been introduced is turnover of less than 15 million and total assets of less than 7.5 million. The number of employees remains static at 50. So it's the financial limits that have changed, not the number of employees. So what's the impact of this then? Well, we can see, can't we, that quite a sizable company with turnover of less than 15 million could be now audit exempt going forward. So a company of that size can be quite significant in its local area or in a particular specialised sector that it may operate. So you may see competitors or suppliers or customers taking advantage of this. When? Well, it applies for accounting periods beginning 1st of October 2024. So quite a change coming up in a relatively short period of time, but we'll see these accounts obviously being filed sometime later after that period commencement. So an interesting development on audit exemption. This was announced back in March, so fairly recently, by the current government. We would not expect that to be changed by any change in government, but you never know with these things. That's the stated intention at the moment, but it hasn't been implemented yet and will require parliamentary time. So we might see a delay to the implementation. So that's audit exemption. Moving on to our next topic then. Let's look at some Companies House changes. Now, these are driven by a law that was enacted in October of last year. So a number of changes will come from this new act, the Economic Crime and Corporate Transparency Act. Now, this was brought in with cross-party agreement, essentially, to try to combat crime, money laundering, corporate crime by using sham companies. So what has already been implemented from this new law, and there's a whole raft of other changes yet to come, but there are three significant things that have been implemented in March of this year. Rules regarding registered offices, addresses, we'll have a look at that in some detail. A new requirement that every company on Companies House Registrar has to have a registered email address with the Registrar of Companies. Now, interestingly, that email address is not to be published, but every company will have to have one, and they'll be used by Companies House for communications with the company. Now, interestingly, that won't be published at all. That will be just private communications from Companies House to companies, and also one email address can be used for multiple companies as well. Another requirement is that when we set up a new company, there's going to be a specific statement of lawful purpose. So clearly setting out a legal requirement. The company's purpose is one that complies with all laws and statutes. For existing companies, that statement will be picked up on the annual compliance statement that we have to file at Companies House. So a couple of changes there. Let's look at the Companies House registered office address changes in a little bit more detail. What is required is that each company now has to have an appropriate address, not a sham address that some company can hide behind. What do we mean by appropriate address? Well, this is defined as where documents can be recorded as being delivered. So it has to be a physical address where physical documents can be delivered to that address. It also has to be a place where a physical person can accept those documents, and that person will be acting on behalf of the company. So in reality, this means that there are no more PO boxes that can be used for companies' registered office addresses. And the penalty for not compliance with this is ultimately the company being struck off the register. So some important changes just to be aware of in terms of company house rules. Let's move on to the next topic then. And we come into the meat of our presentation here, and changes in accounting financial reporting. And these are driven by changes to Financial Reporting Standard 102. Now, this is the principal accounting standard that we use in the UK for those companies that are not applying the international financial reporting standards. This accounting standard 102 is maintained by the Financial Reporting Council. So why are these changes coming about? It's because the FRC, Financial Reporting Council, have committed to a periodic review of the accounting standard. Why do they do that? Well, they want to improve on accounting corporate reporting, but also they want to look at any changes to the international standards and, where applicable, adopt those as well. And we'll see this is the reason for changes in this particular edition of FRS 102. So what is changing? A number of changes. The two principal changes we want you to be aware of is relating to leases and to revenue recognition. When does this apply? Well, it's sometime off in the future for accounting periods beginning in 2026, but that doesn't mean to say that we can rest on our laurels, because this really is a time that we can prepare for these changes. As we go through these two principal changes, you'll see that there's some information that we need to gather and some consideration of the implications of the changes that are coming into effect. So let's look at the first topic then, leases, in some detail then. Accounting for leases. Now, this is a topic that we have covered in previous finance focuses with you. And we've highlighted the direction of travel, and now it's actually arrived the accounting changes. So the new accounting standard will require that all companies place all their leases on the balance sheet. So no more off-balance sheet finance through leases. What does this mean? Well, on the one hand, we'll have an asset, and on the other hand, we'll have a corresponding liability, so the balance sheet continues to balance. Now, the impact on the profit and loss account, this is interesting as well. So the moment where we account for an off-balance sheet lease, then the lease payments are charged against the profit and loss account as an expense. Now, that will be replaced with the depreciation of the asset on the balance sheet. That's described as a right of use asset, so that appears on the balance sheet, and therefore will be written off over a period of time through depreciation through the profit and loss account. And then the interest element of the lease payment will be recorded as an expense in the profit and loss account. So a big change potentially to the look of the balance sheet in terms of assets and liabilities, and quite a big impact on the profit and loss account where you have a number of leases. So let's consider that in a little bit more detail. So if we're putting on the balance sheet the assets and the liabilities, so some key measures will change here. Obviously, people look at the net debt in a company to see what the exposure is there. That's going to increase quite significantly if we have a number of leases that we're now recognizing the liability, and also the impact on certain profit measures such as EBITDA. So that's often used, these measures are often used in terms of bank covenants. So borrowings with the bank, will they be affected by this purely accounting changing? Pension fund covenants, again, we need to look at those where applicable. We've just spoken about audit exemption, but if we're putting loads of assets and liabilities on the balance sheet, suddenly the balance sheet could look quite different. So again, that could be a factor that we need to look at. Do we still qualify for audit exemption if we've increased significantly the value of the gross assets being recorded on the balance sheet? And then what about remuneration, profit sharing bonuses and things like that, and dividends? Again, if we're affecting the profit and loss account, then these measures could be impacted as well. So that's the first important change we need to be aware of, leases then. Moving on then, what do we see next? Well, what is the transition then as we move from the old off-balance sheet to the on-balance sheet accounting for leases? Well, this is going to be quite a simple approach. there's going to be no restatement of comparatives, so not treating it as a full prior year adjustment, but rather we'll have to measure the cumulative effect on the opening reserves, and the opening retained profit will be adjusted for the impact of this accounting change. So effectively what this will mean, we'll have a line showing retained profit previously reported, changes to the FRS 102 as a result of identifying all the leases, and then we'll show the effect of the restated balance, which will be the balancing figure going forward. So in terms of transition then, there's quite a lot of work in identifying what leases we have in the business, and do we now have to move them on balance sheet? What is the cost that we would recognise? How far are we in their useful life? What accumulated depreciation do we recognise as well? So quite a lot of fact gathering to identify the leases involved and how we're going to account for that. Now there are some exemptions for this in terms of low value leases and also short-term leases as well. These exemptions are quite limited, so effectively most leases will be accounted for on balance sheet going forward. So that's the first big change that we need to be aware of. What's the second one that we want to consider? Well, that's revenue recognition. And when you look at the detail of leases, there is certainly room for complication. And this is certainly the case with revenue recognition. What we're doing is adopting a 5-step revenue recognition model, taken effectively straight from the international accounting standards. So here in the UK, we're aligning ourselves with international standards where listed companies and large companies have already adopted this 5-step revenue recognition model. Again, its impact clearly on revenue recognition is going to be on turnover and therefore potentially profit measures such as EBITDA, as we saw with leases. So we're looking particularly at the timing of when we recognise revenue. So this will unwind over a period of time, but as we report in accounting periods, the amount of revenue we now recognise in an accounting period could in some circumstances be quite different and therefore could have quite a large profit impact. Let's explore this in a little bit more detail as to what we mean then. So what are the impacts? Again, if we're changing turnover profit, we need to consider bank covenants, pension covenants, again, the audit exemption if we're changing turnover limits, and again, the impact upon profit sharing schemes such as bonus schemes or share option schemes. And what about dividends as well? Again, if we're impacting revenue recognition, therefore profit, we have to look at the impact if we are in the habit of paying out dividends. So let's look at the 5 steps then. What do we mean by the 5 steps and what is the transition? Well, here it's a little bit more complicated than the leasing transition. We have the option of restating comparatives, or as we saw with leases, looking at the cumulative profit effect and changing the retained opening profit in the accounting periods. So we can account for it as a full prior year adjustment, as we're familiar with, or merely align the account showing the impact on the opening retained profits. So now it's time to look at some more detail then as to what we mean. The 5 steps. Here we have it on the screen, the 5 steps. Identifying the contract, looking at the promises within the contract, determining the transaction price, and then allocating that price to the various promises in the contract, and then recognizing the revenue when that promise is satisfied. Now, that seems at first read quite an easy exercise, but there are these 5 steps we need to go through, and that's on every particular revenue stream. So in a simple company where we've got one source of sales, that may be quite an easy exercise that we need to go through. We still need to go through it in preparation for this change. But in a company where there's multiple revenue streams, suddenly this can become quite a complicated exercise in just preparing for the change. Let's see if we can illustrate some of these points then. So let's take an example then, and we'll look at just the first step. So just the first of the 5 steps. You may recall that was identifying the contract and whether a contract exists to recognise revenue. So let's take the example of a builder of new homes. He has a written agreement to sell one of his houses on his new estate. He's actually holding a deposit from the customer. Do we recognise the revenue? Well, at the year end, we've got some more details. So the builder A ascertains that his buyer hasn't been able to progress his mortgage application. The solicitor is no longer answering emails or telephone calls. Well, no change there, you might think, but maybe it indicates some problem with the progress of the contract. And when the builder looks at his buyer, he finds that the buyer's house is still on the market for sale. He hasn't even been able to sell his own house first. So at this point, under this new regime, we would conclude that a sale is not likely under those circumstances. So at the year end, even though we're holding a deposit and we have a written agreement, we would not recognise the revenue in terms of that potential sale. So let's look at the next slide then for some more implications of this. So a contract does not exist under that first step. We don't recognise the revenue, and the cash that we have received, we hold on our balance sheet as a deposit and do not release it to revenue. So that's one example of the complications that can arise. Let's look at another example now. And again, we'll look at just the first step about whether a contract exists on which we can recognise revenue. Here we've got manufacturer B. So he has a customer that is a regular customer. The customer places an order before the year end, and B delivers those goods before the year end. Now, normally the paperwork that accompanies the sale includes a signed order from the customer. At the year end, we don't have this in place because of some IT issues at the customer. But when we discuss the matter at the year end, the customer is expected to meet the obligation to buy those goods from the previous history. B expects the sales order will be signed, the paperwork will come through in time. And on that basis, in these circumstances, even though we haven't got a signed contract in place and the normal paperwork, we conclude that a sale should be recognised. So different circumstances and a different conclusion. Moving on then. Let's look at step 2. We looked at just a couple of examples on step 1. Step 2 was identifying the promises in the contract. Now, in a very simple contract, we might just have one promise, and that's easy. We can move then on to steps 3, 4, and 5. But let's illustrate some of the complexities that can arise. Here we've got a car dealer, C. Now, a part of the deal to attract customers, he provides a service free to his customers when they buy a new car. The service is provided 6 months after the sale. Now, here in this contract, in these circumstances, we can see effectively there are two promises. One is the sale of the car, and the second one is the provision of the service. So because we have two promises in the one contract, we have to split the revenue. The revenue for the sale of the car is recognised when the customer takes control of the asset, when the sale is made, and the revenue that we would allocate to the value of the service is when the service obligation is fulfilled 6 months later. So you can easily see a scenario, can't you, where the year end falls between after the sale of the car, but before the service is provided. In which case we have to split the revenue and recognise it in different accounting periods as we identify that there are two promises in this contract. Now let's fine-tune this example a little bit in the next example that we've got here. Here we've got car dealer D. Now he's going through his sales, monitoring the sales in August, his busiest month. Halfway through, he recognises that sales are not meeting budget, so he has a sales incentive campaign. He will introduce a new incentive of providing first service for free in each car that is sold in August. Now, customer E has already bought a car before this promise is made on the 1st of August, but D has said he will honour his servicing obligation to all existing customers. Now, in this case, with customer E, there is just one promise in the contract, and that is the sale of the car. So we recognise the entire revenue on the sale of the car that happened on the 1st of August. Now, the revenue relating to the service obligation, no, there's no promise, so we don't recognise that. But what we do have to recognise is the cost of the obligation that's been given in that promise that's been made. So whilst we recognise the complete revenue, we also have to recognise a provision for future costs for when the car is actually serviced 6 months later. So in one example, where there's two promises, we have to split the revenue. In this case, we recognise 100% of the revenue relating to the one promise in the contract. So we begin to get a flavour of the complications that arise when we look at the 5 steps. And we've looked at just 2 of those 5 steps to see the complications that can arise. So when can complications arise? Well, when the expected performance of the contract does not meet the actual stated contractual terms. That can be perhaps through constructive obligations, past performance, where there are multiple promises, particularly where services are bundled in one contract. Then we need to split out all those promises and allocate revenue to each one. And when contracts are modified, perhaps after they've been entered, again, that's an area of complication. So really, with these changes, particularly with revenue, for example, you need to be speaking to your regular Crest & Reeves contact to explore what these mean for you and your business. Let's look at the next slide then to see where this leads us then. Well, what is the action required? We need to look at all our revenue streams in preparation for the implementation of this new change according to the 5-step model. And remember, this is for accounting periods beginning 1st of January 2026. So we have some valuable time to prepare for these changes. Moving on then, what do we see? We see that there are 2 big changes from this accounting standard, one on leases and one on revenue recognition. And they will affect how your balance sheet and how your profit and loss account look in the future. And they're effective for accounting periods beginning 1st of January 2026. So now is the time to prepare. So do reach out to your Crest & Reeves contact and explore what these changes will mean, what information you need to gather in good time so that we're all in a good place for these accounting changes and we understand the implications of them. So that's the topics we wanted to cover there. Let's move on now in our presentation to consider the FRC, so the Financial Reporting Council. Now, their stated purpose is for the public interest in setting high standards of corporate reporting and holding to account those responsible for delivering them as well. So the Financial Reporting Council are the regulator that operates at the top here in the UK in terms of corporate reporting. So what do they see as the main issues in corporate reporting? Well, they've recently published their top 10 issues. So please cast your eye down this list of 10 topics that are concerning the FRC. Now, if your accounts, your financial statements incorporate any of these factors, again, it's something to reach out to your Crest & Reeves contact to make sure that you are up to date with what the FRC's rulings are on these matters. Now, as you would probably expect, the FRC are particularly concerned on areas where there's judgment and choice. Now, there are disclosures regarding those in the financial statements. So impairment judgments are the top 2 that the FRC are concerned about. Perhaps surprisingly, for larger companies that have to report on their cash flow statement, they often find errors in the cash flow statement, so that's in at number 3. Number 4 is something that auditors in particular need to be concerned about, and that is on narrative reporting. And what the FRC are concerned about is in the director's report, the strategic report, often the very glowing report from directors don't really chime with the actual numbers that follow later in the financial statements. So it's that disconnect between the narrative reporting and the hard numbers that the FRC are concerned about. So have a look at that top 10, think about your accounts and consider whether any of those top 10 issues relate to you. Now, the FRC have issued thematic reviews on most of these areas, so there is some guidance on the FRC's thinking on these matters. Moving on then to our next slide. Let's just conclude with a brief thought about ESG reporting. So environmental, social and corporate governance reporting. These are issues which are getting a lot more attention, both in the general press and obviously in the financial press as well. So what's happening in the regulatory landscape? So here we're talking about sort of non-financial reporting. Here in the UK, listed companies already have to report on certain ESG matters. Large companies have to report on their carbon reporting. So this is already coming into place. This is increasingly important to customers of certain companies, and interestingly as well to employees. Often employees embarking on a career will consider the ESG impact of their chosen career and look at the accounting of the potential employer and consider whether that's a business they want to be aligned with. So it's something we need to be aware of, and its rising importance. Now, in terms of what's the regulation around this, obviously it's a new area of reporting. It's not on hard numbers as such, so it's quite a judgmental area. So as I mentioned, here in the UK, listed companies, large companies always have to report on this already to a limited degree. In the European Union, there's a new standard that the EU will be applying to corporate reporting, and that's probably going to influence us going forward. The international standard body that's responsible for this has released 2 new standards on reporting, and the UK government has indicated that it expects to adopt these in 2025. So reporting on ESG matters is going to increase in the future. It's something we need to look out for, to be aware of. It will affect listed companies and large companies first of all, but inevitably we can expect it to drip down to smaller companies as well.